You're tuned in to the Brand Ambassador Select Podcast.
How's it going? And welcome back to the Brand Ambassador Select Podcast. For our new listeners, hello, I'm your host, Lenore. So we're heading back to our financial wheel today for today's show. There's no better time than to start building your future than now. On episode 7 of the Brand Ambassador Select Podcast, Dao Phan, the CEO of Matirx Consulting Group Services, joined us to explain how important legacy planning is, no matter your age, no matter your income, and no matter your net worth. Her goal is to educate the mass amount of Americans, the 95%, with the knowledge of the 5%ers. Because Dao Phan has so much knowledge to share, we had to have her back for another episode. She's going to discuss how to create more cash flow, how to prepare once our taxes increase in 2026, and why now, right now, is the time to invest. Dao Phan, welcome back to the Brand Ambassador Select Podcast.
Hi, how are you? Looking forward to chat with you again this round.
Yes, so the last time you told us all about your practice and all the different services that you offer the financial professions regarding legacy planning versus financial planning. Now, you did talk a little bit about the blind spots as a big hurdle to American families regarding their personal finance. Can you really elaborate more on that and give us better examples?
Sure. When you get a chance, go ahead and load up the photos. It's an example to the reference links from the Congressional Budget Office. When I gave the example last time, it was a reference to the 2017 Tax Act. It's quite extensive, but the main key points in that Tax Act is basically letting the American family understand how their the marginal tax rate will be raised starting January 1st of 2026. So you can choose to pay your discount tax now or basically end up paying more starting then. What you're looking at right now as an example, when you think of your current tax rate, it ranges between 10% to about 37% is the highest. And that's basically going to be locked in from 2018 to 2025, okay? And you can see in that example on the background paragraph there, it says at the end of 2025, okay, the tax rate will expire, and then the beginning of 2026, if you have 10%, you remain the same. But if you have 12, you raise up to 15%. If you have 22, it'll be 25, and if you have 24, it'll be at 28. 32 going to spike up a little bit to 33. 35 remain the same. But if you have 37, now it's going to be at 39.6%. Of course, that's just only federal level. Now you add up, states, and of course, city like New York, you have city tax add-on. It's like getting a pay cut, basically.
Yeah, doesn't sound so good.
Nope. So for a lot of Americans, you actually still have a choice to control that tax rate by paying your rate now, which traditionally most Americans will put money in a 401k, IRA, or some form of tax deferral. My recommendation is you might want to consider put into what they match and then pay the current tax rate and redirect that difference, not spend the difference, but redirect that into a tax advantage vehicles that can give you, that you don't have to pay any future earning taxes on your gains. And that would be much wiser ways to do it. So, and then for the folks, of course, retiring now where they're not contributing anymore, you might want to consider as you start distributing, you have the next 5 years to distribute to gauge in the tax rate, but at the same time redirect that difference elsewhere. So that's where our practice comes in, just help the client redirecting appropriately, but looking at the overall picture.
Well, thank you for that, because I listened to you and I got it, but you were just with all the numbers. I was like, thank gosh, I can just call Dao Phan, go to howmoneyworks.com, and she could just help me out, because for a lot of people, that sounds scary, and it doesn't have to be. We need to know that it's okay, that if we're scared, you'll at least help us guide through to better our finances and to better our future.
Exactly. And remember, our consultation, there's no cost in getting a review and learning information too. Even when you find a good match in whatever plan you want to implement, you can go ahead and feel free to, you don't have to work with us at all. And if you should find our services complimentary, don't bill you for the services and the implementation. We charge our partner providers that you, no different when you go into Fidelity or Prudential companies out there, we charge our vendors our fee, not the client. They don't get a bill from us.
Which is great. That makes me feel even more secured about saying, hey, I need help, and more confident to say, listen, like, please sit down with me. I would like to take that next step into bettering my future, into bettering my legacy of mine and my family's as well.
Exactly. So if you look at the second, picture where you talk about historical tax rate there since 1913 to 2020, taxpolicycenter.org did a great job. And look at, remember I said earlier, the tax rate, the highest right now is at 37%. But if you look back in history, even in the decade in 1950s, to all the way 1963, the highest rate was somewhere hover between 91, 92%. Even if you take a step backward in time, from 1931, when it was 25% federal rate, right at the following year in 1932, it went up from 25 to 63%. So if your rate was that high, what about the middle class? If you were at 91, 92%, the middle class somewhere between 60 or 70%. Can you imagine paying that rate on your income tax right now?
No, that's like the opposite. No, I don't know. I don't want to think about it.
Well, the tax hike is just the beginning itself. Myself as the expert and many experts believe that it will continue to go higher, and that's where people are going to get slaughtered. They have to be careful. And then the third key point is where you talk about provisional income. And that's taking back a step where if you look at what is provisional income, it's an IRS way to calculate how much of your Social Security income benefit will be taxed. So usually most Americans will collect between 66 to about 70 years old. That's the age where they start collecting Social Security. Give and take a few months difference, okay? And whatever the amount of Social Security you're taking right now, let's say you're collecting 30,000. Well, you take half of that, which is 15,000, and put in that formula. And then if you have earned income, interest, dividends, then you put in that bucket. But if I say you retire, you don't have any more earned income or interest, rental properties, those things add on. But you're only pulling out from your tax deferral bucket, which is your retirement 401k pension. Imagine you add that together and you got a provisional income formula. Whatever your number is, if you look at the tax threshold right there, let's say you're a married couple and combine that, you're above the 44,000, expect 85% of your Social Security income benefit to be taxed. And there, of course, there's a spread out in terms of how much you pay. But again, who wants to pay 85% of their Social Security benefit to be taxed, right?
I don't want to pay 85% of anything. Like, I don't want to be taxed 85% of anything. I don't care if it's my Social Security, none of it. I don't want any of it.
So there's ways you can actually eliminate and prevent that as well. Again, talking to a professional will help you, avoid those blind spots, which could be devastating to someone's finance. And last but not least, it's really long-term care and catastrophic illness. You're looking at, we may not die, but we could suffer from cancer, stroke, heart attack. There's still copay and deductible. I don't care how good your health insurance is, those healthcare deductibles are still there.
Yep.
And of course, you may have elderly parents or grandparents with a fracture, hurt themselves. They might have to go to a nursing home or dementia, and they might need someone to take care of them around the clock. Can you afford if you're in the South, it's about $5,000 net. If you're Northeast, it's at least $10,000 to $15,000 net a month.
Yeah.
It can easily put someone in bankruptcy quickly when it comes to the medical expenses and long-term care. So again, those are the main 4 blind spots that we want to make sure that the family are properly planned, or at least be aware, and then you can actually negate or correct the course early on.
Thank you for that. You are super duper informative. So if anybody is listening and they do want to, pause, rewind, and go back and listen to it, feel free to do that as well. But we are going to move on. So thanks for all those blind spots down. So what are some of the recommendations you offer to, listeners and even your clients regarding their household debt and their cash flow?
Well, consider the stimulus checks and the CARES Act. I'm sure, most people right now are, let's say if you're self-employed, you should definitely apply for the PUA, which stands for the Pandemic Unemployment Assistance Program. It would definitely boost your cash flows. If you're right now unemployed, of course, you can apply for that. And then, of course, the $600 stimulus will help each week. Definitely apply if you're affected in that arena. So that will help. And then, of course, get a financial checkup, looking over your expenditures. We have a certain habit, which you can develop good habit or bad spending habit. But find out what's necessity versus accessories. I'm sure a lot of people are staying home. Unfortunately, for some of us, eat a whole lot at home, gain some weight, but you don't have to eat out the past month or two. Look how much money you've saved. Look at it from that perspective. Consider current debt. Looking at the low interest credit. Let's say maybe you're affiliated with some credit unions. It could be a lower interest rate loan, 0% balance transfer. You can go to creditcards.com. Maybe your credit score is average, decent enough. You might want to apply for it. If you marry, apply separately, so you have two credit lines rather than joint one credit line. You might want to do a home equity line of credit, a loan in terms of, but it has to tie into a home renovation with the new law. So you can tack in and consolidate some of your debts. Why? Your credit card and car notes, the interest cannot be written off, but the interest from your mortgage, you can also claim back. So that's an extra bonus and consider a little bit better debt, similar to student loan. Or maybe a 401k loan where they charge you 4 or 5% versus a credit card could be 20, 30%. So again, it's about consolidating your debts and helping you be disciplined so that you can actually have a debt-free process. And sometimes you may not even need to use a third party to help you. You can actually do it yourself, save you more money.
Oh, it sounds even better. But again, it's howmoneyworks.com/Dao Phan, right? That's how we can get a hold of you.
Absolutely.
Good, because I think I need your assistance, at least for now. And then, as we go forward and as I continue to learn from you, maybe I'll start pulling away a little bit, just a little bit. I'm not there just yet, just so you know.
There's no shame in getting started, people, because the reality-wise is just knowledge is power. And rather than, living blindly and just kind of go by what everyone is saying or just the norm, why not get the facts yourself? And then from there, you'll be, you're smart enough to make your own decision. Just start with the basic fundamental, and then from there, migrate into the money that you would pay your debts. Why not reinvest it yourself, and then let your money go work for you? I always remind the people, don't forget to pay yourself first. Outside your creditor, you got to pay yourself first, save for the rainy days. It could be as little, by the way, my practice help clients to save as little as $50 a month.
Listen, anything put aside adds up.
Exactly. And you'd be amazed. Think about that Starbucks you go to every day. You add up 30 days. How much would that be? Well, you reallocate that into your saving and investments. Now it could be $300, $500 a month. And next thing you know, you have a couple $100,000, million, 2 millions. 30 years compounding can go very far.
And you'll be living your best life.
There you go.
So Dao, what are some of the recommendations you would offer to, the listeners, your clients, to really improve their finances, considering the market and the low interest rate environment that we're currently in?
Well, that's a great question. When the pandemic broke out, the market pretty much went from 29,000 down to 19 within basically about a month. I mean, luckily right now we're back up to about the 25,000 mark as we speak now. It's definitely adds so much stress in the financial with the market loss to so many Americans' overall portfolio and their retirement. So when the market is down, it's actually a great opportunity to buy. I mean, just think about ladies. Don't we love to go shopping at a clearance? All right. And then again, it's like buying a foreclosed home versus buying at a peak price. So market correction is actually a perfect opportunity for you to invest. So that's in this. For those of you who've been hoarding cash, this cash is king. This is the time you really want to put your money as a working capital for you. And work for your financial professionals, or give us a call and get a free consultation to learn more in terms of how to gauge so that we look at your risk tolerance, your goals. And then again, it's about holistic planning, tie into the tax planning part, right? Most importantly, it's not only about how much money you make or even invest, but it's to show you how much, you net from your taxes or even the tax advantage. I mean, that's really the important key. When you think about it, how can you build up a great portfolio and pay the lowest taxes legally, is the key to a comfortable future. And obviously your savings, your retirement, and at the end of the day, I'm sure when you have built all that nest egg, you want to leave a legacy behind to your heirs, not to necessarily Uncle Sam, right? And we've seen it through our practice through probate and estate planning, where if you don't plan it properly, it could be detrimental. You could leave half of it to Uncle Sam. So it's about putting your money to work for you versus you work harder for your dollar at the end of the day.
True. Yeah. I'd rather give it to, my kids and my grandkids, let them prosper than for it to go somewhere I don't know.
Exactly. And by the way, just on a side notes too, we are, because of the pandemic, actually our business is booming and we are in the process of expanding so much. And so I'm in the process of interviewing many candidates for our virtual on-demand planning positions. So if your audience listening and they think they're a great candidate and have the right discipline, we will train them in the next 90 days to learn about how money works so that they can actually apply it. But then through our contracts, we work with so many government, private companies, hospitals, and the Department of Education across the nation. So these entities come to us in terms of providing on-demand services for the employees. So we will dispatch these clients out to our future candidates that works from, basically they get to work from home during this pandemic.
Yeah, sounds awesome because you guys were already remote to begin with for most of it. So it just shows that you're just thriving through.
Exactly. So they can definitely contact me through my site itself, and then from there we'll talk more in terms of the interview and the training.
Well, once again, Dao Phan, thank you so much for joining us today and sharing all of your knowledge. And I know that you probably have so much more. So to start investing in your future and building your legacy, you can head to howmoneyworks.com/Dao Phan. You can also give her a call. Her number is 917-807-6416. Dao, again, thank you so much for educating us today. And again, if you're listening and you want to, just rewind back and re-listen, especially to those blind spots at the beginning, they're super important. And thank you. I'm gonna be the one that rewinds back. It's like, what did she say?
Well, it's better that you talk from your own personal experience, right?
Yes. So I'm your host, Lenore. Thank you once again for joining the Brand Ambassador Select podcast, and I will see you next time for a brand new episode.